Hello everyone, good morning. Clifford Bennett, Chief Economist, ACY Securities. We've seen in the US market overnight a little bit of a rally in equities, but it was almost as if people had forgotten what had happened on Friday. People had very short memories over the weekend. And it seems as if people, something happens and it's a long-term event. And it means that for the next 4 to 8 meetings in a row, the Federal Reserve will be hiking rates. And that is the flood of data that we've had that inflation in the US is reaccelerating. So why is it that everyone suddenly even, sort of just has a weekend and then forgets that, that's right, sorry, I forgot. The Fed's still going to be hiking and the US economy is having a momentary blip, but then durable goods yesterday crashed. So durable goods crashed in January. That's not a good sign. There are a couple of other things that look a little bit healthier on the month. But again, such as the consumer spending data we saw. But again, I think January might be the best month economically for the United States this year. I do think there's a chance that the United States will be one of the weaker performing economies in the world this year, which forces us to question a little bit the US dollar longs. So the US dollar is torn between a weakening economy, which is what I expect, even though a lot of people are getting excited about 1 month's data, and an ever higher interest rate yield as the Fed continues to fight the fight against inflation. Nothing's going to change on that front. The Fed isn't going to change its attitude about inflation. The Fed's going to keep raising interest rates. So what we need then is a decision by the market between whether the US dollar goes up or the US dollar goes down. And I think we're probably going to see for the moment the US dollar rising, but after the US dollar is headed higher for a period of time, maybe 2 to 4 weeks, maybe 6 weeks, maybe a month, then we could be looking at a US dollar that starts to move very quickly to the downside in a big way. And I might have mentioned this to you before, by kind of 10, 15 or 25%. Yes, 25%, but that would take 2 to 3 years. But that's what I'm talking about. I'm talking about a historical shift in how people consider the US dollar. And it is long overdue. I gave a speech at APEC in 2012 as the first economist in the world to come out and say, and then books were written about it afterwards, that there's going to be 3 equal reserve currencies eventually, the yuan, the euro, and the US dollar, and the market is heading that way. Recently it's been in the headlines, that idea again, as if it's somehow breaking news, but no, a lot of us in the economic fraternity, we've been talking about it for over a decade now as a 10 to 15 to 20 year forecast, and we're halfway through that forecast period. So that's what's going to be happening, and it's going to be happening because the US dollar is now one of several potential reserve currencies. It's not the only reserve currency. So there, at one stage, I think it was, back in the 1980s, the US dollar was drawing in, or the US economy was drawing in 70% of the fresh available capital in the world for investment. 70% of the world's available capital was being sucked into the United States. That quickly fell to 40% around the turn of the century. And I think that will remain under pressure going forward, even as US trade and fiscal deficits grow. So that's not a healthy outlook for a currency. The thing holding it up, as I said, is really this idea that the Fed will be hiking. And I think that will be a significant pressure for some time. So I tend to be a buyer of the US dollar on the dip, but if it were to start to fall too much, I'd probably become a seller. So I want to buy the US dollar now, but I'm forever mindful that in the background, at some point, there could be a historic shift in how the global investment community perceives the US dollar. And that could spell really a lot of trouble really for the US economy, because it has been propped up to a large extent by foreign capital. At the moment, the US is experiencing declining equity markets, declining bonds, declining property prices. So that doesn't depict a very strong economy or a great place normally to put your money. It's the Fed losing the fight against inflation, because it is. Inflation is reaccelerating. It's going to force the Fed to continue to hike interest rates aggressively for an extended period of time, which means the US dollar can rise from here. So the takeaway is buy the US dollar now, but be ready to one day sell the US dollar in a big way. Thanks very much. Clifford Bennett, Chief Economist, ACY Securities.